In Boston, in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, we explore one of the biggest industries in the region, healthcare, as we sit down with the CEOs of Boston Children's Hospital as well as Care.com. Plus, turbulence and turnover at GE has upended the company's plans for the city of Boston. We explore exactly what happened. And Chinese tech titans report positive earnings results, how Alibaba and Tencent are adapting to the slowing economy in China. And we are live from Boston this week, showcasing the innovation, diversity, and power of the regional tech economy. Today, we're at the Greater Boston Chamber of Commerce annual meeting from the Boston Convention Center. This year's theme, Women in Business, All In. Now, the Chamber brings together leaders from a broad and diverse representation of the businesses, industries, and people driving the Greater Boston area economy. And we'll get to that in just a moment. First up, though, to a developing story out of Washington. President Trump signing an executive order today, actually Wednesday, that could restrict Chinese telecommunication firms Huawei and ZTE from selling their equipment in the United States, ratcheting up the battle for control over the new 5G technology networks. Let's head to Bloomberg's Alex Wayne. He's in Washington for the details on this. We were expecting this executive order. It's been around for some time. Alex, what does it exactly do?
Yeah, this order has been rumored for upwards of a year, and we reported actually in January that it might be issued as soon as February. Then it wasn't. It's been put off a couple of times. I think there's been some internal debate in the administration about what exactly it should say, how far it should go. The executive order doesn't name any company or any country. It doesn't outright ban Huawei or ZTE from selling their products in America, but it does give the Commerce Department the power to review purchases of products made in countries that are considered adversaries before those purchases go through, and those are purchases by any private company in the United States.
Alex, this order was not meant to single out any company nor country, but yet it does come at an interesting time when the U.S.-China trade relations are not going so well.
I wouldn't say that it wasn't meant to single out any country or company. It doesn't. The words China or Huawei are not in the order, but I think it's very much aimed at China and Huawei. I don't think we should pretend it's not aimed at that country and at that company. And yes, it absolutely ratchets up tensions at an already sensitive time between the U.S. and China. We're in the midst of watching a tentative trade deal between the two countries collapse, and as a result, the trade war that's now more than a year old between the U.S. and China is escalating. This order can't help.
Exactly. All right. Thanks for the details. We appreciate it. Alex Wayne there in Washington. Now back to Boston's annual Chamber of Commerce meeting tonight. Care.com CEO and founder Sheila Marcello will be inducted into the Academy of Distinguished Bostonians. She founded Care.com back in 2006 after her firsthand experience as a working mother seeking care for her children and ailing parents. Well, today the digital platform is the world's largest online destination for managing family care, serving more than 31 million people across 20 countries. Sheila Marcello joining us right now to talk about it. Nice to have you here.
Thanks, Carol. Good afternoon.
Well, I want to get to your honor this evening, and I want to talk about what you're doing at the company, but I've got to talk a little bit about earnings. This week you did beat in terms of the first quarter, but some disappointment about the second quarter outlook. What can you tell us about growth at the company right now?
Specifically, we're really focused on building trust overall, given what our brand stands for, and really focused around background checking and improving overall our delivery of our offering for families.
Well, and that's something that you guys have focused on in terms of additional safety enhancements, right? In terms of the caregivers that are part of your platform. So talk to us a little bit about that, because that I'm assuming is additional cost to the company.
Yeah, so what we've added is actually safety enhancements that's focused around Social Security, verification, enhanced in-depth background checks that include 7-year criminal record history. And we just think investing in these kinds of things is really important for families and long-term value for our shareholders.
Now, Sheila, you deal with caregiving, but you also deal with it at for children, for seniors? Give me an idea of where the growth is in terms of the business.
Sure. It's interesting, Carol. You actually pointed out senior care is one of our fastest growing verticals. We're very excited about it. And the mission of Care.com is actually to find trusted, affordable, scalable care for families. And we serve the chief household officer, usually mom. And that means everything from child care to senior care and lots of services in between, whether it's pet care, tutoring, housekeeping, all in one place that they can find great care.
You know, it's interesting. We've had Senator Elizabeth Warren certainly talk about universal health care for all. In terms of your vantage point and what you're seeing, the cost, sometimes the difficulties in getting care for families, is that even possible in an affordable way?
Right. What I love about what Senator Warren and other politicians are talking about is it's less about politics. It's about the importance of families and to provide them choice. Now, I think universal child care stands for making sure that there's enough affordable care, but we need to provide a variety of care. That includes in-home care and making it accessible, because Care.com actually doesn't charge an agency fee on top of it. We just provide a subscription service, and then families can find the care they need at whatever cost they negotiate with the different caregivers. And so providing affordable care, we have about 25% of our families actually are 50K income household and below. So we're constantly trying to make sure that we're providing a scalable solution for families.
What's the role of corporations? And I think about that because some folks at Amazon, some others have kind of been pushing the company to be more proactive.
Right.
What is the role of the private sector? And I'm curious if you're reaching out to more companies or more companies reaching out to you to try to figure out programs.
I think it's a very big role. I'm super proud of Boston for taking the lead for Boston companies and the chamber backing paid leave, really important, pay equity, everything that really supports women, but also a benefit like care benefits, like care at work. So if we think about companies in the local Boston area, Boston Children's Hospital is a client, Dana-Farber, many of these great Boston companies really provide care benefits so that their workers can show up for work. And I think it's really important. So I'm proud of the Mamazonians. I think that they're speaking up and they're really articulating what's important for them, because there is this interdependency, Carol. You need great care to work, and you need to work to pay for great care, because it's so expensive.
Now, I think what you do, you have access to a lot of critical information in terms of individuals, healthcare, and I'm just curious what you're doing in terms of securing that data and data privacy.
Yeah, so what's very interesting for us is it's non-medical. So from a HIPAA compliant perspective, it doesn't actually touch Care.com, but we invest quite a bit around privacy and cybersecurity. We're GDPR compliant with Europe. We're getting ahead of the California requirements for privacy that's due in January. So it's something we take very seriously because it's about protecting families and caregivers.
So let's talk a little bit about the award you're receiving right now. And I love the theme, Women in Business, All In. What does all in mean?
To me, it's really being able to bring your authentic self to work and who you are in everything that you do. So when I first got my job, I actually hid the fact that I was a mom. And I realized that I only was in that job, Carol, for a year. I realized I wasn't being true to myself. And that was both my responsibility of finding a work that I could fit in, to be all in, to be who I am, but it's also making sure that work takes on the responsibility that embraces diversity.
So cultures have to change within organizations.
Absolutely. And we have much more to do, as you know.
All right. Well, congratulations on your award, and thanks for taking time out for us. We really appreciate it.
Such an honor. Thanks, Carol.
Thank you, Sheila. Sheila Marcello, of course, Care.com CEO and founder. Well, coming up, everybody, we've seen Uber and Lyft hit the public markets, but we're still waiting on more tech companies to do so. We'll talk with one startup investor about the environment. This is Bloomberg. Welcome back to Bloomberg Technology live in Boston. I'm Carol Masser. In a year of highly touted IPOs, we have seen some really big names such as Lyft and Uber miss the mark, while others such as Zoom and Beyond Meat do pretty well. And we're still waiting on a few others like workplace software platform Slack, which is opting to go to the direct listing route later on this summer. Bijan Subet is no stranger to watching startups go public. In fact, his VC firm Spark Capital has invested in companies including Slack and Trello. He was on Trello's board in the early days and led Spark's investment there before the company sold to Atlassian for $425 million. A success story, no doubt about it. He joins us now. Nice to have you here with us.
Thanks for inviting me. Great to be here.
I got to ask you about the IPO environment right now. What do you make of it? Do you consider the Uber and Lyft IPO a disappointment?
Well, certainly if you're a late-stage investor, you're probably disappointed. I think it's a complicated story. The company went public fairly late compared to other tech companies. As a result, the growth isn't what a lot of public investors want to see. So on one hand, you look at a company that's worth $60, $70 billion, depending on the day.
Right.
And it's remarkable that a company 10 years ago was worth zero. On the other hand, they raised most of their capital in the last, 3 or 4 years, and those investors are probably not jumping up and down, but it's still very early. The company has been public.
But it's been around for 10 years, like you said.
I meant the public stock.
Yeah, no, I get it, but it's been around for 10 years and still not profitable, right? So does that make sense to you? You understand this startup world.
Yeah. Look, I think that the thing about Uber that's different than a lot of companies we've backed is Uber has this challenge where they have to subsidize rides for the consumer.
Right.
At the same time, they spend a lot of money acquiring attention from drivers. It's a challenging business model, and typically that's difficult when you have to basically incentivize both sides of the marketplace.
Talk to me a little bit about IPOs versus direct listings. And I know Spark, not something that you worked on directly, but is considering or is planning to do a direct listing from what we understand. Why are we seeing that? And do you anticipate more startups are going to go the direct listing route?
Yeah, I mean, direct listing clearly is an option for some companies. Spotify had a successful direct listing. We're investors in Slack, so I have to be careful about what I say there. But I think the real thing is that most companies, it's not a possibility for them. I think they really need the brand of a Spotify or a Slack to do it.
Right.
To get that attention with the street, with investors, coverage, float, etc. So I think it takes a special kind of company with a special kind of brand, but it could work out quite well.
So I want to ask you, you were an early investor in Twitter. Social media, what do you make of kind of where it began and where it is today and some of the concerns over it?
Yeah, I mean, clearly where it began, where people would just tweet out what they're having for lunch and where we are today is pretty remarkable. It's changed quite a bit. I think it's an important part of the conversation, clearly, for us to have access to what our leaders are saying, what people are saying locally, have things still break in real time. I still think it's the definitive place to get information and to be able to comment on that for fun, utility, etc. I think it's very important. But clearly there are challenges with having this kind of capability.
Well, what do you see in terms of we've seen more oversight. We certainly see it among European regulators. Where do you think it's all going? Is it going to be just even more rules and regulations when it comes to social media? And should there be more rules and regulations?
I mean, for me, I think the real concern I have is what's happening at Facebook with data and privacy.
Right.
I think Twitter is a different case. In full disclosure, I'm still a shareholder of the company, etc.
Yeah.
I'm no longer on the board. But I think the Facebook regulatory concern is warranted. I think there have been calls for the company to be highly regulated from co-founders. Even the founder, Mark Zuckerberg, thinks they should have a different view of how they behave themselves. So I think you're going to see more oversight in the U.S. and in Europe, and it's probably deserved.
So when you look to make investments in the future, you like these online communities.
Yeah, very much so.
I mean, what kind of communities are you looking for or expecting that we'll be playing with in the future?
Yeah, I mean, we have our latest one is a company called Discord in San Francisco. It's a massive social network for gamers,
That's a huge area.
Yeah, it is quite big. It has 250 million users they just announced recently, so it's massive. It has a different dynamic than, Facebook, where it's people talking about games.
Right.
Yeah.
So gaming?
Correct.
Is that going to be any other kind of social media platforms that you think in the future?
We'll see. I mean, I think social networking broadly is an important area, and I think we're seeing it play a role in the workplace, in verticals like gaming. So we're still pursuing it.
I do also want to ask you about, I love your website. I was kind of reading through it. It's like creating a movement, a little crazy, a magical product on a mission. I do always wonder about when I talk to someone like you, the kind of trends that we're seeing that you're starting to do, very early seed investing, that will be kind of more dominant in our world in 5 to 10 years. You talk about gaming. Are there other things?
Yeah, I mean, we were early investors in a company called Cruise Automation that GM bought. Right. This is the leader in autonomous vehicle technology. It has profound implications for cities, urban planning, transportation, jobs, how work gets done. I mean, it's a very exciting technology, but it has real considerations.
Is that playing out as you expected in terms of the timeline for self-driving and autonomous? I mean, I really do feel like Elon Musk and others really helped speed up the process, but is it playing along as you expected?
Yeah, I mean, this is a combination of technical advancement required, but also it requires cities to sign on board, consumers to have confidence that it can happen, but ultimately self-driving should be safer than human driving.
Tell me a little bit about the investment environment. Lots of opportunities out there. It seems like there's an awful lot of cash moving around for things.
Yeah, I mean, we are certainly in a time.
That can be bad for valuations or prop up valuations.
It's difficult. I mean, it's or challenging, I should say, but it's also exciting to see all sorts of new investors come to market, individual investors, angel investors, but it's definitely a new time.
Listen, great to get some time with you.
Great.
Thank you so much. Bijan Sabat, he's co-founder and general partner at Spark Capital. All right, coming up, everybody, Chinese tech titans Alibaba and Tencent reporting earnings. What do those results tell us about the ongoing trade war? We'll take a look at that. And if you like Bloomberg News, do check us out on the radio. You can listen to us on the Bloomberg app, Bloomberg.com, and of course in the U.S. on SiriusXM. This is Bloomberg. This is Bloomberg Technology live from Boston this week and at the annual Chamber of Commerce meeting. I'm Carol Nasser. Let's now turn to earnings today. Alibaba and Tencent both reported results. Alibaba revenue and profit topped estimates as personalized recommendations really drove consumer spending. Tencent sales, meantime, fell flat even as net income beat, boosted by gains on investments. Well, for more reaction, let's bring in Kevin Carter, founder of EMQQ. It's an e-commerce ETF, joining us from San Francisco. Kevin, nice to have you here with us. Alibaba and Tencent among your top holdings. Both those seem to be struggling a little bit, it seems, from the slowdown in the Chinese economy. How do you see it, though?
Well, if 51% growth, which is what Alibaba reported, is a slowdown, then I think it's fine. There's no doubt that the Chinese economy is slowing down. It's been slowing down for a long time, but that's not really news. I think that Alibaba's report was fantastic, and I think what Joe said about the tariffs benefiting Alibaba was true, and Tencent, of course, has its own idiosyncratic issues with the gaming and the gaming regulations.
Well, let's go through Alibaba. As you said, some of the numbers, core commerce business, I think, was up about 54%. You had their cloud revenue surging 76%. Are those the standouts for you? Walk us through some of the different metrics of their report.
Well, the core commerce business is their business, and notably, they've dropped the E from e-commerce. So that's the majority of the business, over 80%, and it grew at 54%. And there's very few businesses in the world that wouldn't envy a 54% growth rate. The cloud business is an important business, and it's a business they've been investing in, and it's still growing extremely well, 74%. I think expected to grow at the average of 50% for the next several years, and past $1 billion. So business is great, and as Joe said, the core of the tariff issues, once they're resolved, are the things that are going to really help Alibaba. I mean, Alibaba is well positioned to benefit from whatever resolution comes to the trade dispute.
Well, and it is interesting. I mean, so many of your investments, I do wonder about how you look specifically at what's going on between the U.S.-China trade negotiations and the impact it is having on companies right now.
Well, it's having a big impact on the stock market, obviously. Sentiment seems to move, a couple points a day, depending on what the headline is, and the last week's been negative. But, for EMQQ, we own internet companies in China and India and Africa and South America, and this is a secular trend. And it's not really something that's part of the trade wars, and the trade wars are about agricultural products, manufactured products, and importantly, it's about rebalancing the Chinese economy towards consumption, towards Alibaba, and a lot of that involves, buying U.S. goods. So I think longer term, or once it's resolved, Alibaba really is in a good position to benefit from the imbalances that are trying to be corrected.
All right, talk a little bit more about Tencent. As we mentioned, while Alibaba, their ADRs were up in the U.S. trade today, Tencent shares, Tencent ADRs were not. So tell me a little bit more about, they've been making some forays into new businesses, specifically fintech. How do you see their outlook right now?
Well, obviously they've been affected by gaming and the government's restriction of new gaming licenses, which hurt them a lot last year, and they underperformed the broader market in Alibaba last year. They're underperforming this year, and there's some light in the tunnel in terms of gaming moving ahead, which is their main business. But the fintech part of the Tencent story, and also of the Alibaba story. I mean, this is the thing that I think most Western investors don't appreciate is that the entire Chinese economy is ripe for digitization. And so Alibaba and Tencent are basically owning the online payments market. And once you own the wallet, there's all sorts of things you can expand into, insurance and otherwise. So that's a very bright spot in the Tencent business.
Hey, Kevin, do you ultimately see, though, as these U.S.-China trade negotiations go on, and if the U.S. continues to push back and maybe ask for and push for more openings for U.S. companies over in the Chinese market, will it impact something like a so established or well-established Alibaba and Tencent?
Well, I think it'll affect them positively. I mean, again, at the core of the sort of trade tensions and the tariffs and trade wars is, China exporting a lot and not, buying as much of our stuff. And the good news is China knows they have to rebalance their economy towards consumption. It's happening. The consumption numbers continue to be quite good. And there's no company better positioned for the future of consumption than Alibaba and Tencent in its own, but different way.
Hey, one last question. Your advice to investors right now in terms of their exposure to Alibaba or Tencent?
They're both very reasonably priced companies. On their growth rates are while Alibaba's is significantly higher than Tencent's in today's reports, they're both growing quite well. The PE ratios are reasonable. The PEG ratios are less than 1, and buy and hold both of those companies.
All right, going to leave it on that note. Kevin, thanks so much for your time today. Kevin Carter, he's the founder of EMQQ, joining us from San Francisco. Coming up, more from the 2019 Greater Boston Chamber of Commerce annual meeting. Our chat with Boston Children's Hospital CEO Sandy Fenwick on its newest partnership with GE Healthcare. That's coming up next. This is Bloomberg. Bloomberg Technology live in Boston. I'm Carol Masser. It was supposed to be GE's crowning moment, the company deciding to move its headquarters to Boston with its promise of infrastructure and jobs in exchange for tax relief and incentives. But somewhere along the line, it all went wrong. Here's how it went down.
For over 40 years, General Electric called Fairfield, Connecticut home. That changed in January 2016. The company announced it was moving its headquarters to Boston.
Jeff Immelt, who was CEO at the time, was really trying to reinvent the company as a digital industrial company. They wanted a software focus. They wanted to be closer to engineers from MIT and Harvard, and Boston really was a good fit.
Boston and GE look like perfect partners. GE would build a brand new 12-story corporate headquarters in Boston's Seaport District and bring 800 new jobs to the city. Boston pledged $25 million in property tax relief, and the state of Massachusetts kicked in $120 million in additional incentives. Boston Mayor Marty Walsh was exuberant about the deal.
$150 million in incentive package. How will you know if it's worth it? I think it's already worth it. When GE, the 8th largest company in the world, is moving to their global headquarters in the city of Boston. We have other great companies as well, but General Electric is kind of one of those that's such a big win for our city.
1 year later, in May of 2017, the good feeling was still flowing at the groundbreaking ceremony for Innovation Point.
I think Boston should look to the future with great promise and with great optimism. This is the start of what I would like to call a terrific relationship.
By the summer of 2017, though, the ground had shifted for GE.
Started to sort of see cracks in GE's financials. So their cash flow was a huge disappointment. Their organic sales growth really did not materialize to the level that they had promised. You know, when John Flannery was named CEO, I don't think anybody realized quite how bad things were for GE.
In August 2017, the company announced it would delay construction of its new tower, pushing completion back 2 years to 2021. And as GE's cash crunch intensified and its stock price plunged, Jeff Immelt's digital dream slipped far down his successor's list of priorities.
I think the problem was that Immelt was too grand in his vision. He was too ambitious. He wanted GE to be the be-all, end-all of all things software for industrial companies. Especially as GE's cash problems started to mount, it became apparent that this digital effort was too ambitious. So that's why you started to see first John Flannery and then later Larry Culp, his successor, walk down that ambition.
We have a lot of work to do at GE. We need to strengthen the balance sheet, and we need to set the businesses up to win.
In February 2019, GE abandoned its plan to build a new corporate headquarters and announced that only about 250 new jobs would come to Boston. The company won't be seeking property tax relief, and it reimbursed the state of Massachusetts for $87 million in expenses. GE will remain in Boston as a renter after reaching a deal to sell the land at Innovation Point to a real estate development group.
It's definitely something that needed to happen, and I think they're going about it in the appropriate way, you know, not just from a cash management standpoint, but from a PR standpoint. They're clearly trying to say that we like Boston, we want to be here, but we just don't have the capacity that we did when we started this process.
Well, our next guest is no stranger to Boston, and his cloud storage company, Wasabi, is taking on the likes of Amazon. It is headquartered here in Boston. David Friend joining us now on set. Nice to have you here. It's a little noisy, but we'll make it through. You know, we just did a story about General Electric, and I do wonder about this bigger, broader story about industrial companies looking to kind of pivot and compete in an increasingly digital world. And we know that General Electric wants to be kind of the industrial Internet of Things company in terms of software in the industrial space. But talk to us, it's not so easy, though, for these companies to make that turn.
No, it's very hard, and when you look at the giants in the information technology space, Amazon, Google, Facebook, Microsoft, and so forth, they really started as in this new digital way,
right?
And it's very hard for industrial companies that are used to doing things in a certain way. Everything from technology to accounting is entirely different, and the culture is different. So I think it's very hard to do, and quite honestly, I think people still need manufactured products, and I'm not sure that it's a good idea for people who are making goods to try to pivot.
True to kind of who you are in terms of your
Somebody's still got to manufacture the goods.
Yeah, that's a good point, right? There's a lot of goods that still need to be manufactured.
Yeah, and attempts to change have not been notably successful.
I have to ask you, because you talk about companies trying to do something different. You are trying to do something different in terms of the cloud storage space, and you are taking on the likes of some of the huge players that are out there. Amazon, I'm thinking about Microsoft. You're much cheaper, and I think one of the numbers I heard, you offer a terabyte of storage for just $5 a month. It's much cheaper, it's faster. How can you do that?
Yeah, it's about 1/5 the price of Amazon storage, and up to 6 times faster.
How can you do that?
Well, Amazon, first of all, we've been in the cloud storage space for a long time.
Yeah.
My partner and I started a company called Carbonite, which is, millions of people use for backup.
Right.
And so we're cloud storage specialists. And we actually write software that gets down and controls the movement of the heads on the disk drives. It's very arcane, complicated software. Most people never, even programmers, never think about things like where bits go on a disk. And Amazon storage product is now 12 or 13 years old. They really haven't done a whole lot to change it. So this is a whole new generation of storage. Wow.
Just for us, just for us.
A little noise.
We're going to try and power through. But I do wonder, there are some that make, some that actually the drumming stops so we can continue. So some make the argument that if you're storing in an Amazon cloud your data, and you're going to also want your applications running in the same space, what do you say to that?
Well, Amazon has over 100 different cloud products, and they can't be best at everything. But they do have something in practically every category you can imagine. But just like when I was growing up, if you walked into a data center, every piece of gear in the data center had an IBM logo on it.
Right.
Then EMC, a local company here, came along and ate their lunch in disk drives, and somebody else came along, took the printer business away, and somebody else came and took the memory cards away. And I think the same thing will happen with the big integrated players like Amazon. There are people who do storage better than Amazon. There are other companies who do just compute in the cloud better than Amazon. There are other people who do things like content delivery, how this TV show is going to be delivered to listeners all around the world.
Right.
They do that better than Amazon. So the future will be multi-cloud. It'll be sophisticated developers will use the best of breed for each of these applications.
But I do wonder, David, though, at that lower price point, I mean, how long can you do that to kind of keep scaling up your business?
I couldn't hear you.
At that lower price point, how long can you continue to do that to keep scaling up?
Well, the cost of storage is dropping every year, and we're growing like 25% month over month because we have a really an amazing sales proposition. And we don't want to be everything in the cloud. We just want to be the best at storage, and we think we can keep that edge for a long time to come by focusing 100% of our attention on storage. Storage is an enormous market.
We're going to leave it there, and you've been a sport, because I know it's a little loud, drums and all, but thank you so much. Really appreciate it. David Friend. That's, of course, David Friend. He's the CEO of Wasabi. Still ahead, content delivery company Akamai serving some of the biggest tech companies from Apple to Facebook, but will it be able to compete as its clients increasingly rely on their own cloud tools? We'll talk about that. That's next, and this is Bloomberg. Bloomberg Technology live from Boston. Now, after a strong start to the year, shares of cloud delivery platform Akamai took a turn for the worse this month. Last week, the company was on track for its longest losing streak in over 3 years, falling for over 7 straight days. Now, the company is still up about 26% year to date as it attempts to expand its security business. Joining us right now to talk about the business, the outlook, is Akamai CEO Tom Layton. That was a rough start to get into.
Oh, actually, the year's off to a great start.
Well, talk to us about, I always wonder when the CEO sees their stock price down. As a publicly held company, investors kind of hold your feet to the fire. I don't know, how do you see it? And what are the conversations that you have to have with investors over it? Or do you even have to have any?
Oh, obviously, I spend a lot of time with investors, and the conversations are very good. We grew our security business in Q1 almost 30% year over year. Our earnings per share grew over 40% year over year. So investors have been, I would say, very happy with Akamai.
Well, and what do you make of this market environment generally overall? Do you see it as a CEO? Do you just say, I write it off to the U.S.-China trade jitters? Is there concerns about a little bit of a global macro slowdown? How do you see it?
Obviously, there's concerns about the U.S.-China trade agreement, and I think that's had an impact on the market. The good news is the tariffs and the things that are happening don't impact us directly.
Right.
Our business is doing well in China, good relationships there.
Does it impact it though, Tom, at all when there's these tensions between the two countries?
We haven't seen that impact our business. I think as any global company, you worry when you see the tensions at the macro level. You don't want to see a trade war. We'd all like to see a fair trade agreement worked out. But right now, day to day, it's not an impact on Akamai.
I want to ask you a little bit about your business too, that we do see increasingly some of the bigger companies, relying more on their own cloud tools. How does that impact you guys, or is it?
There are some very large cloud companies that do delivery themselves, and so we wouldn't have that business. That said, the business that we do with the cloud giants grew in Q1 year over year, and we carry a lot of the internet's traffic, including for the biggest cloud giants.
I also want to ask you about the IPO market. It's certainly been, in addition to U.S.-China trade, I feel like everybody's been focused on the IPO market this year, finally kind of getting some momentum, but different results, if you will. You guys, I think, went public back in '99.
We did, yes.
A long time ago. What do you make of today's IPO debuts and some of the differences that we've seen? Lyft and Uber not doing so well, Beyond Meat doing well, Zoom doing well?
It's a frothy market right now, I would say. Not as frothy as it was in '99. And so when you have that kind of situation, it's not surprising that you see some of the share prices fall. And it's especially for companies that are losing money, if you don't maintain a wildly high growth rate, which you won't forever,
right,
then you come back down to earth pretty quick.
That's a great point. I mean, I do think about when you guys went public and when you were starting up. I mean, there's so much money around now from the venture capital community, from family wealth offices, from private equity, that a company can stay private for a much longer time. I think about Uber, right? Private for 10 years, still not profitable. I mean, does that distort in some ways how we value companies?
I think there is some distortion, and it's easy to get into when companies aren't profitable because there's no notion of a price-earnings ratio because there's no earnings.
Right.
And then you get into sometimes the revenue multiple, and that's a very dangerous place. And the market is valuing growth quite a bit, but you don't maintain those early-stage growth rates. And in the end, profits matter.
I want to ask you, too, about being here in Boston. This is where we've been all week. I'm just astounded by the amount of development, building that's continuing to go on, the intersection of medicine, biotech, venture capital, technology. What is it about being based in Boston that has been, really a plus for you guys? Because you've been here for a long time. This is your roots.
Yeah, the talent here is incredible. And you have the great universities. We've moved half a dozen times over the last 20 years. We've always been with the block of MIT in the computer science and AI lab there, where we actually started the company at MIT. Just the talent's extraordinary, innovative, eager to work on really hard problems. And that's what, we're doing at Akamai. So we loved starting the company here. We're very happy we stayed here, and we're flourishing and growing here.
You mentioned talent. As a CEO, I constantly hear, Tom, from folks that's what's difficult, finding talent nowadays. Are you guys finding those difficulties as well?
We find great talent here.
But is it competitive?
Yeah, it's competitive, but one big advantage for Akamai is we're headquartered here. And a lot of the other cloud giants that have woken up now and discovered, hey, there's real talent here, and they've moved offices here. Headquarters is, back in California, and it makes a difference when you're hiring. So we compete very successfully for talent.
Well, Tom, nice to catch up with you again. Thank you. Really
Thank you very much.
Tom Layton, of course, he's the CEO of Akamai. Well, that'll do it for this edition of Bloomberg Technology. Thursday marks the final day of our coverage in Boston. We'll be broadcasting from Sterling Plaza on the gorgeous Rose Kennedy Greenway, so we hope you'll join us. And this is Bloomberg.